Hello everyone, thank you for joining us for today's discussion as we consider perspectives on the current inflation. This discussion is presented by First Bank Wealth Management. First Bank Wealth Management, our goal is to help you sleep better so you can dream bigger. Let me introduce myself. I am David Frederick. I am the Senior Vice President and Director of Client Success and Advice with First Bank Wealth Management. My role with First Bank Wealth Management is to help people plan for their retirement, for their estates, for their businesses, for tax mitigation, all sorts of things like that. In addition to that role, I'm also an adjunct professor of economics at Washington University in St. Louis. And today I'm going to be putting on my economics professor hat as much as anything else as we consider today's discussion of inflation. Before we begin, let me give the disclaimer. The opinions expressed in the presentation are statements of the speaker's opinions only, are intended only for informational purposes, and are not necessarily the opinions of First Bank. Everything I say today is educational only and is coming from my own perspective. So, as we've been watching the newspaper for the past several months, we've been seeing headlines like this. CNN Business, a key measure inflation surged to a new 30-year high, October 1st, 2021. October 14th, 2021, Forbes Advisor says why inflation matters for Social Security, Medicare, and your 401k. The New York Times, November 10th, 2021. Fastest inflation in 31 years puts more heat on Washington. There's a political aspect to this. Bloomberg Business Week. Getting inflation right is a make or break moment for Wall Street. November 17th, 2021. There's a business component to this. Inflation, in fact, seems to be a very hot topic recently. But that doesn't mean that everybody perfectly understands it. What is inflation? Where does it come from? How does it work? Today we're going to have a primer on inflation and how it might impact our finances and some of the steps we might take to mitigate its impact. So let's start. What is inflation? Inflation can be thought of in two very similar related ways. Number one, it is a rise in price level for the same goods and services over time. That is, when the quality and quantity of goods is not increasing, but prices are increasing. You're getting the same stuff, but it's costing more over time. And the natural flip side to that is that as prices are rising over time for the same items, there's a decline in purchasing power of a currency over time. That means the dollars in your pocket and in your bank account are actually losing value over time. In other words, inflation occurs when it takes more money to buy the same goods and services. In fact, the more money it takes to buy the same goods and services, the higher inflation is rising. The more inflation rises, the more money it takes to buy the same goods and services. So, a natural question to start with is, are we in fact facing high inflation right now? Well, let's take a look. The chart that you see on your screen is the annual price changes in October. This is October 2021 compared to October 2020. As provided by the Bureau of Labor Statistics and presented by the New York Times. You'll see that there are several areas of sharply increasing prices. Notably, fuel oil is up 59%. Motor fuel, that's gasoline at the pump, is up 50% in price over last year. Car and truck rentals up 39%. Utility gas up 28%. Then we get down to some of the foods that we see. So beef and veal up 20%. Bacon and sausage up 15%. There seems to be some sharp increases across the board over prices from last year. Now, not everything has gone up. You'll notice at the bottom, public transportation, the cost has gone down 1%. Recreational books, airline fares, health insurance. I don't know why that's dropped off, but that prices on that are gone down. And then the big one is food at employee sites and schools down 45%. That's probably a topic for another time, but that goes to the changing nature of education and employment following the COVID pandemic. Let's focus in a little bit more on another sharp indication of inflation, and that is retail gas prices over time. This chart shows the gas prices for the 36-month average over the past 3 years. So starting in 2019 up through the present day in 2021. Now, we need to put a line in here for the coronavirus pandemic that broke out in March of 2020. And you'll see the red line that's kind of on the screen shows a sharp decline in gas prices because fewer people are driving everywhere. But let's put in a trend line for everything that took place before the COVID pandemic in March of 2020. This trend line tries to show the average, about $2.58 a gallon prior to the COVID outbreak in March. And it provides sort of the average price. Now, if we were not facing inflation, we could expect that prices might come back to where they were before the pandemic, but not surge past them. So the trend line could be thought to continue on at $2.58 a gallon. But what we notice is that especially since about March of 2021, prices have not come back and normalized where they were prior to the pandemic. In fact, they have gone well above, and they continue to be trending upwards. That is fuel prices. Inflation is also charted here from the New York Times. One of the things about inflation is that fuel prices and food prices tend to move around very sharply. And what you'll see with the dark blue line on this screen is that inflation that includes fuel and food prices, in fact, bounces around quite a bit. That's the dark blue line. But the light blue line is inflation without food and fuel prices. And let me see if I can trend line that for you. The trend line for the light blue line is just about 2% per year, which is more or less the target rate for the Federal Reserve when considering inflation. And what we've noticed is that since the start of 2021, we have a sharp rise in inflation, about 6.2% year over year from the prior year, if we include food and energy, but still about 4.6%, more than double the target rate for the Federal Reserve when we take out food and energy. So there is indeed sharp inflation right now in the American economy. So now that we see that inflation is in fact present in the modern American economy right now, this leads to a natural question. What causes inflation? Where does it come from? Well, let us recall that inflation is the increase in price over time. It is inherently a price mechanic. And at a basic economics level, price is always seen as a relationship between supply and demand. Supply is how much goods and services are available to consume, and demand is the amount of goods and services consumers want to consume. Now, before we go on, let me make one quick note about demand. Often people think of demand as a psychological measure, like how much would people want to consume based on their mood. But demand in economics is not a psychological phenomenon. We assume that psychological demand is pretty well constant. People will consume the maximum amount they're capable of it. Instead, when we think of demand, we think of the availability of money that is used to consume. How much money is actually around, how much money is actually available. And the availability of money is a stand-in for economic demand. Thus, price is a relationship between supply and demand, and what that means is that for our purposes, price is a relationship between the supply of goods and services available in the economy, as well as the supply of available money. So the basic law of supply and demand says that when supply goes down, the amount of goods and services available to purchase goes down, and demand goes up. Remember, that's the availability of money. Demand, or the amount of money available, goes up. Prices go up. This is the basic concept of inflation. In simple terms, there is too much money, there's more money available that is chasing after fewer and fewer goods. There's more money available and a decreasing amount of goods for all that money to buy. This perspective on inflation is summed up by a very famous quote from Milton Friedman that said, "Inflation is caused by too much money chasing after too few goods." I want you to remember this quote, and you'll see it on the screens as we continue this presentation, but this is a good way to consider what inflation is. Inflation is caused by too much money chasing after too few goods. And we'll keep that on the screen as we go forward. Does this explanation explain the current inflation? Well, let's consider it both from a supply side and a demand side. So from the supply side, we have seen in the past several months massive supply chain disruptions because of the COVID pandemic, the worldwide nature of the COVID pandemic. We've seen lots of movements in the supply chain grind to a halt or face bottlenecks and loggerheads, things like that. Goods are stuck in transit, finished goods especially, are stuck in transit trying to reach American consumers and are therefore not on store shelves. Right now, there are relatively fewer goods to purchase. So let's illustrate this visually. If you've been watching the news lately, you've probably seen pictures like this. These are cargo barges off of the coast of California near the ports of Los Angeles and Long Beach. Let's zoom in for a closer look at one of these. Each of these cargo ships contain hundreds, if not more, cargo containers. And each of those cargo containers are filled with especially final goods for consumption by American consumers. And they are largely languishing off the coast of California. This picture is from about 3 weeks ago, but the process has not improved substantially yet. There's still a big bottleneck at the ports. There's also a big bottleneck at the ports because there are relatively fewer cargo drivers to drive cargo away from the ports. And what this leads to is a relative bare shelves in consumer retail markets. Now, not everywhere has bare shelves, but especially as we approach the holiday season, there's relatively fewer and fewer consumer goods that are available. So that's the supply side. There has been a relative dearth of supply as caused by the COVID-19 pandemic. Let's consider the demand side. Again, remember, inflation is caused by too much money chasing after too few goods. So, has there been a substantial increase in money in the economy lately? Well, if we're asking how much money is actually in the economy, the best place to check is the balance sheet of the Federal Reserve. Now, the Federal Reserve Bank is a banking system that is responsible for creating all new credit or cash into the United States circulation. All credit, all money in the United States originates at the Federal Reserve. And the Federal Reserve's balance sheet generally shows how much new money has entered the system. So let's take a look at the Federal Reserve's balance sheet. Now, this is the Federal Reserve's balance sheet dating back to 2008. And you can see that prior to about 2008, the balance of money was about $1 trillion in the economy. And then with the financial crisis of 2008 and 2009 and 3 rounds of quantitative easing, the Federal Reserve put in about another $3 trillion into the economy, give or take. And it held more or less constant from there in 2015 until 2020. Well, in 2020, with the outbreak of the COVID pandemic, the Federal Reserve started to pump a lot of money into the system. In fact, here we see that in the course of about 18 months, the Federal Reserve has more than doubled the amount of money in circulation, more than from $4 trillion up above $10 trillion, about $6.2 trillion of new money has entered into the system. Now, where's all this money going? Well, historically, when there's a lot more money entering the system and we have high demand, we have increasing wages as part of this. As unemployment rates go down, employers have to compete for labor, so wages tend to go up. As wages go up, people have more money to spend. With that more money to spend, inflation goes up, especially if they're chasing after fewer and fewer goods. This is something that the economists refer to as the Phillips curve. So has there been rising wages in the past 18 months to help explain this extra amount of money coming into the system? Well, as we look at wages over the past 2 years, we'll notice that, in fact, there has been an interesting pattern. Again, we see the drop-off in wages from the COVID pandemic starting in about March or April of 2020, and wages tumbled precipitously, especially around times of unemployment and business shutdowns and general lockdowns. Well, as the economy started to open up again near the middle and end of 2020, wages did start to rebound. But something happened, and in about April of 2021, there was a substantial increase in American wages, an increase of about 14.55% year on year from the prior year, and hovering about a 10% increase as the labor market tries to adjust to the new normal of the post-COVID world. Rising wages can, in fact, therefore explain some of the increase in total money availability, but it's unlikely to account for the full $6.2 trillion of new money in circulation. Let's go back to the Fed's balance sheet and take a look again. So we see that from 2020 into the present day, there's been about $6.2 trillion of new money in circulation. the Fed's balance sheet can actually be broken down, and we can see where that money goes more specifically. This is an indication of the Fed's balance sheet broken down by asset classes held on the Fed's balance sheet. This is rather technical, but the thing that I want to point out here is that there is one asset that has increased substantially over time since about March of 2020, and that is Treasury securities held outright by the Federal Reserve. What this means is that the Federal Reserve has actually been creating new money to buy Treasury debt from the federal government to help fund spending from the federal government. That it's the Federal Reserve has been creating new money to purchase the bonds of the federal government so the federal government may have more money available to spend. In fact, this purchasing can be seen in some of the spending that the federal government has been doing in the past 18 months or so. Consider some recent government spending. The CARES Act, the initial federal response to the COVID pandemic, saw $2.2 trillion in spending take place very quickly. Then in December of 2020, the Consolidated Appropriations Act put another $2.3 trillion into the economy. After that, with the new presidential administration, a new spending took place with the American Rescue Plan Act, March of 2021. That's another $1.9 trillion in new money into the economy. And then just recently in November, the Infrastructure Investment and Jobs Act passed, which plans to put another $1.2 trillion into the economy. That money has not been spent yet, but that is projected into the next several years. And then finally, there's the Build Back Better plan, which has not passed yet, as of the recording of this presentation, but which may spend about another $1.75 to $4 trillion into the economy over the next several years. The takeaway from this is that there is in fact a lot of money in the economy right now, and a lot of the money is coming from the federal government. A lot of this money is circulating, and there's more and more money, an extra $6 trillion over the course of about 18 months, that has been added to the economy from government spending. So we see that there's a lot of inflation in the economy right now, above 6%. We see there's a lot of additional money in the economy. There's relatively fewer goods and services in the economy, which means that there's a fair amount of inflation. But this begs the question, is inflation inherently a problem? Is inflation inherently a bad thing? And the answer is no. A modest amount of inflation is actually a pretty good thing for the economy. Now, the theory behind this is that the opposite of inflation is called deflation, and deflation is almost universally considered a bad thing for the economy. So we're always trying to avoid deflation, and the way that we do that through the Federal Reserve System is to have a target of 2% inflation per year. A moderate amount of inflation can be a good driver for the economy. However, inflation can become a problem when it rises too quickly or is higher than expected. This seems to be the state of inflation right now. Recall that if we're having a 2% target for inflation, then total inflation is above 6.2% right now. And if you take out volatile food and energy prices, it's still 4.6% inflation, still double what the Fed's target is. So with high inflation, with dollars in the bank becoming relatively less valuable, with prices going up, what should people do to help make ready for their finances for a high inflation economy? Luckily enough, there are several simple steps to take to help prepare your assets, to help prepare your financial plan for an inflation economy. First, very simply, is to avoid holding large amounts of cash. Cash is considered a toxic asset during inflation. What that means is simply that cash is perpetually going down in value. If you have lots of money sitting around in your bank account, that money is losing value over time, and during high inflation, it's losing money at a pretty high rate. It's a good idea to put some of that cash to work in something that can help protect against inflation. Number two, to actually become a winner in an inflationary economy, seek out fixed rate debts, especially while interest rates are low. As inflation continues to rise, dollars tend to lose value. What that means is if you're actually a borrower of a fixed rate debt, then as dollars go down in value, you will be repaying your debts with dollars that are less valuable than the initial dollars that you borrowed. Now is a very good time to refinance a mortgage, especially while interest rates are very low, because the money that you borrow is going to be worth relatively more than the money you use to pay back that loan, especially if inflation continues. As a quick note, variable rate inflation or variable rate debt does not have this advantage. If you have a variable rate debt on, say, a credit card or a home equity line of credit, perhaps, those rates will tend to adjust with inflation, so that this benefit does not come through quite as brightly. A fixed rate debt, especially a low interest rate mortgage, is an excellent way to take advantage of inflation. Also, consider investing in inflation protected assets. The classic asset to help avoid problems from inflation is gold, potentially silver or platinum or other commodities like that. Those are good stores of value. They never drop to zero, and they can help weather the storm of inflation. There's also a special bond issued by the United States Treasury called Treasury Inflated Protected Securities, or TIPS. These bonds have a return that increases with the rate of inflation. So while inflation is high, they actually provide an increasing rate of return, which can be very valuable as a hedge against inflation. I would also encourage you to consider diversified stocks, bonds, real estates, and alternatives. A diversified portfolio, as a general matter, can help weather an inflationary period pretty well. So don't put all your eggs in one basket. Get into a diversified portfolio that includes some amount of gold, silver, other commodities, some amount of Treasury inflation protected securities, stocks, bonds, mutual funds, and the rest. If you're really aggressive and you think inflation is going to continue for the long run, it's possible you could short the United States dollar. That is a very risky move, but if you want to be a real winner on inflation and you are able to call it correctly, potentially shorting the dollar is in fact a way to get ahead during times of inflation. Other ideas. As a general matter for your personal finances, limit discretionary spending. If you put off buying the car, if you put off the trip, if you put off remodeling the house while prices are high, you'll save money. As more and more people put off consumption, the amount of money in circulation will tend to sink back down to a parity with the increasing amounts of goods and services into the economy. So as more and more people become more and more frugal, inflation will start to slowly recede. So consider delaying consumption on especially large discretionary purchases. If enough people do that, inflation might be fixed. I will say as a side note, this cannot take account of government spending, however. Government spending into the economy can still sort of dwarf what the American consumer is capable of. So it may still be a good idea, however, to simply put off your large consumption for your own purposes. Number two, because there's so much money in the economy right now, it may be a reasonable idea to consider asking for a raise at work. The labor market is very interesting right now. There are lots of open jobs. There are relatively few workers. And asking for a raise might give you a chance to get to a relative parity of what the value of your job is actually worth right now. If you don't get a raise, there are in fact lots of jobs out there that might provide a higher income. Be ready to work with the inflationary impacts on your cash flow and what your expected wages should be. Also, be prepared for tax increases. One of the tools that the government has to offset inflation is to use taxation, especially tax increases, to drain money out of the economy and to replace the revenue that is received from the Federal Reserve. So the Federal Reserve creates more money out of thin air and puts it into the economy through purchasing government debt and government bonds. To the extent the government raises taxes to replace the revenue coming from the Federal Reserve, it may lower inflation. It will have an impact on the people whose taxes are increased, however. So be prepared for tax increases. Do work with a financial advisor on what are some of the best tax strategies going forward, especially if the tax laws change in the next several weeks or months. And finally, be prepared for a recession. So inflation often is the forerunner to recession. There are several tools that the Federal Reserve has at its disposal to combat inflation. This was the key at the end of the 1970s, the start of the 1980s, when there was very high inflation. These tools are effective, but they will commonly lead to recession in the economy. And that makes some amount of sense, that money is being taken away from an economy. Money becomes a little bit harder to come by, trying to allow money and goods and services to come back into parity with each other. But to do that, the economy needs to, or naturally does, recede as the Federal Reserve uses some of its tools to combat high inflation. I would also encourage you, most importantly, do not panic. Inflation can be a difficult circumstance, but it can also be weathered with good advice and good financial planning. Do not panic. Instead, I would encourage you to reach out to a First Bank financial advisor for assistance in navigating this area, for assistance in understanding a good financial plan that takes into account high inflation, for assistance in understanding what investments can be made to help offset inflation. Please do reach out to a financial advisor at First Bank Wealth Management. If you'd like to get started, you can reach me directly at david.frederick@fbol.com, the email address shown on your screen. Thank you so much for your time. This has been a very brief primer on inflation. To discuss this or other topics, please do reach out. I look forward to hearing from all of you. Thank you very much.